Everyone is saying that the bull market is back, baby. We rose 20% from the bottom of the S&P, and here we are entering a new bull market cycle. We're gonna be testing the all-time high short enough and into open discovery of the market. Woohoo! No, guys, I wanna calm you guys down. This is a nice rally. I've been telling you guys to take some profits, but this is just a complacency stage of the market psychology of Wall Street, of Bay Street, wherever street you're on. This is not the beginning of a rally. This is just a phase, and we are going to continue to go down. We're going to enter into a recession, like I've been saying, into the second half of this year, into the beginning of next year, and this recession be going on for more than 10 months, to be honest. There's so many bubbles, I lost count on them. But in this video, I'm going to go into so much data on how we think, the public thinks, that we're going to be into a rally with so many things that are indicating that the bull market is only a dead cat bounce. That's taken quite nicely. We're in complacency stage. We're not going to be testing the new all-time highs and enter price discovery. In fact, we've seen this in the same markets just in the past. Okay? This isn't anything new, ladies and gentlemen. I want to make sure that you guys understand what's going on. The bull market is not really the beginning. This is just for amateurs. The retail investors that don't know what they're doing are going to be holding the bag, and the institutional players that have been keeping this, there's a lot of call options that have been keeping the market afloat. And once they start putting puts on once they start selling, they're going to basically pull the rug, and the retail investors, the mama pops, on their phones and on the couches, are going to be holding the bag. They've been calling up their money managers saying, hey, we need to get into this semiconductor rally, the AI rally. We need to get into the big 7 of the S&P 500. Meanwhile, the 493 have not been doing too well in the S&P 500. In fact, not only have they been going sideways, they've actually been trending down. And only the big 7 have been doing quite well. Here at the Financial Almanac on Basel, we're going to find out more. Let's get into the data, ladies and gentlemen. If you're a new investor, you may not know this, but if you had a little exposure in some cycles of the stock market, you know the market has a very dark sense of humor. When you think it's a bull market, it'll pull the rug under you. When you think, oh my God, there's panic and blood and stay away from the market, it rallies. So this max pain effect is gonna be happening soon. Everyone is thinking, hey, we're in a bull rally, and next thing you know, everything is gonna drop like a hammer, like an anvil, like the Titanic. The beauty of this market, even though it has a dark sense of humor for a lot of people, it's going to cleanse a lot of filth. Ladies and gentlemen, people have been riding the coattails of quantitative easing and 0% interest rates. That's great for the economy, they said. But these money managers, these unethical practices that a lot of people have used, unfortunately, not only is it bad for the mama pops, because here we are with their pensions being depleted and there's nowhere else to go for these money market managers. They're giving them packages that have junk bonds in it, junk stocks in it, junk everything in it, and they're saying your portfolio's good, your retirement years are around the corner, and just don't look into what those assets have. But the AAA, according to our buddies over there that are giving it a green light, and lo and behold, it's a shiny apple with worms inside. You know what I mean? There's so much unethical practices, and they've been riding the coattails of quantitative easing and 0% interest rates for God knows how long now. I've lost track. That happened for like a third of my life. And now that they're saying that there's a stock market rally and we've entered into the bull market because we came up by 20% from the recent lows, these guys have only been tested when the market is doing great. We're in the middle of something else, so we haven't even reached the end yet, and I don't think these guys are going to do as well as they think. I think a lot of people are going to be feeling the pain because they've been suckered into and have been following the Pied Piper for way too long, and then they're going to pay their price because they did not take hold of their own financial future and they let somebody else do it for them. Well, this market rally, right? It's not going to be here for long. We're in the middle of something else, and the end is going to be horrifying. And I want you to make sure that you're safe. And here's the data. Let's get right into it so you have no reason to doubt. I want you to keep in mind that the reason this data is here is so we can build up a thesis, so you can have an understanding and a reasonable foundation for a conviction. If your conviction is strong because you have strong data and you've seen a pattern before and it's gonna happen again, you have more of a conviction that the results will turn out like last time. If the data is the same, if the data is different or the pattern is different, you might have a conviction that it'll turn out slightly different, whether it rhymes or is completely different. That's up to your analysis. Here is my conviction with my data and why I think the dark sense of humor of the stock market, well, is about to happen and take place. In this market, we have so many people either taking the bullish side or the bearish side. And a lot of bears recently have capitulated and entered into the bull side, meaning that they really believe this time is different. And so when somebody says, Basil, it's over, the bear market is done, we've entered a technical, bull market, I want you to ask them this. Can you say it is different this time? Because we're about to retest the all-time high and enter into price discovery. Tell me why you think it's different this time. If you're a bull, write down it is different this time so I know exactly who you are, because this video is for you. There's an overwhelming amount of evidence that'll say otherwise, but I want you to specifically say it is different this time, like Jerome Powell has said.
However, this cycle is different from other cycles.
All right, so let me hear it. Do you think it's different this time? Let me know down below. So the first data I want to present to you is the yield curve inversion. It's been the highest it's ever been. And anytime this reverts back, guess what happens a few months later? A recession. In fact, this is the biggest it's ever been. So I expect the biggest recession we will witness. You know what I mean? This is going to be unheard of, ladies and gentlemen. But if you believe that there will be a soft landing and a mild recession, let me know down below. It is different this time. You know what? You might be right. It might be different this time. There might be an exception to the rule today, but just say it. Say it. Let me hear you say it. It's different this time. So if you're saying, okay, that's just one piece of data, what's your next piece of data? ISM manufacturing and services PMIs is dipping into recession territory, ladies and gentlemen. So let me know you whether or not this is the exception or the rule. Because if you think this is just an exception and not the rule, let me know down below. It's different this time. In addition to both of those points, the third point I want to bring up is every time we see the money supply crash like this, we enter into a recession. But no, it's not a recession. It's not even that bad. Well, it might be a mild one. And it might be a soft landing. It's different this time, Basil. It's different this time. Say it! Yeah, no, the collapse of the money supply, no, that doesn't matter anymore. What about same-store sales? We've seen that that's been declining quite drastically. But no. Let me guess. It's different this time. Next, I have corporate profits. When we see corporate profits dip this low, year on year, from highs to lows, it generally means we're going into a recession. But I know what you're gonna say. No, Basil, listen, it's different this time. When we look at the global economic activity surprise index and we see it coming down, and not only that, at the end over here, we just crashed. Let me guess, in this bull market, it is different this time. Let me hear you say it is different this time. Okay, what about China? China recently opened up their country. They're supposed to be exporting a lot, but now they've entered into negative territory. But let me guess, it is different this time. It's not doing too well. But what? Oh, the bull market's here? Yay! Let me hear you say it. If you're a bull, let me hear you say it is different this time. All right, what about the ISM New Orders Index? We see that it entered into negative territory, and anytime that happened, we enter into a recession. And you're telling me that, yeah, no, it might be different this time. Okay, let me hear you say it. It is different this time because, this is the exception, guys, ladies and gentlemen. This is the exception, even though ISM New Orders generally indicate that we enter into a recession. All right, what about copper? We see inventories for copper drop. They haven't been this low in the last 18 years. And demand for it has plummeted as well. But let me guess, this is a sign that it'll turn around into an economic expansion and not a recession. You still think there might be a soft landing? Ladies and gentlemen, let me hear them say it. Let me hear the bulls say it. It is different this time. When we look at the probabilities, the odds of a recession, according to the S&P, we're at 55% that there might be a recession. According to the base metals, which tend to be a stronger indicator, we're at 89%. But no, this is the one time that'll be different, Basil. Trust me, I've been in these markets before. I can tell that it'll be different this time, right? Next, I'll share with you the divergence between equities and bonds. And we see there's a great difference over here. And in Wall Street, they say bond markets never lie. It's always telling the truth. Well, if the bond market's always telling the truth and the equities right now are at a pretty good high rebound, let me guess, we've entered in a bull market. Let me guess where there might be a soft landing, and this divergence doesn't mean anything. Let me hear you say it is different this time. Even though JP Morgan said stocks will plummet 20% if the bond market expectations pan out. Don't be ashamed to say it. Maybe there is a bull market. Maybe there is a soft landing. Don't be ashamed to say it. It is different this time. Next, I want to share with you investment grade junk bonds and speculative bonds and how their yields are moving higher. And prior to this, there's always a crash and it precedes, economic recession. And I want you to look at this and say, oh, but you know what, Basil, it is different this time. Next, I want to share with you household excess savings and how that has been dropping like a black diamond ski slope. And it's in negative territory, but not only that, we see credit card balances reach a really, really high rate. And not only that, bank deposits have entered into really ugly territory and banks are contracting their credit and loan facilities. But let me guess, all three of these data, household excess savings, credit card debt, very up there, very high, and bank deposits, not only dwindling and leaving banks, but also credit conditions for bank lending have contracted. All of this means, yes, no, there's an economic expansion happening, right? No. Let me hear you say, bulls, that this bull market, this soft landing, because it's all different this time, right? Okay, on to the next one. So a lot of bulls usually go to their number one, jab. They'll say, oh, but unemployment is very low. There's a huge amount of job creation around, and guess what? That's really good, and that's a good sign for the bull market. So if your premise on a bull market and a soft landing is that the employment rate and there's jobless claims, how did you guys know that it's usually a lagging indicator? Usually for all the cycles, that if a job recession unemployment rates go up, it's usually already in the middle. The recession has already begun, right? The unemployment rate would finally show up in the middle of a recession. It's always a lagging indicator. And if you don't believe me, let me show you the initial jobless claims. Here we see in this graph the initial jobless claims. We see that ticking up since October, and it's going to continue to go up because we also see that permanent job losses have recently started ticking up, and when that goes up, unemployment rates start to be collected and released, and it's usually always a lagging indicator to an economic recession. Even though in the recent job report we've seen a good report overall, we see a lot of sectors lose a lot of jobs. Here we see auto, consumer products, leisure, hospitality, transportation services, financial, retail, tech, all lose a lot of jobs, and they're multiples of what they used to be. And we still have not recovered from the pandemic era where a lot of jobs were lost in certain specific sectors. Here we see that certain sectors at the bottom have not recovered since the post-pandemic era, and their jobs have not been created. But after seeing all of this, guess what? You're still bullish. You still believe that there might be an economic boom and an expansion, and there might be a soft landing, and everything will be mild and great, and the stock market will do well. Let me hear you type below, it is different this time. Okay, so it's different this time. So what is different this time? Why is there so many people trying to get into this market after it went up drastically? Is it because of AI? AI, CNN says, is the reason that all of this is possible. Very interesting. Okay, let's look at some of this theory of AI. We've seen mom and pop basically sit out of the market while institutional investors, put up Nvidia, put up Broadcom, everything is rallying. They saw 30%, while they're on their couch. And then they saw a 40% increase from Nvidia, while the mom and papa retailers are not involved in this market because they've been burned and they want to get into Nvidia. And so they see that 30, they see that 40, and now it's at 100. They call up their money market manager saying, hey, let me get into this bull run because the bull runs have officially come, baby, let's go. And we've seen that they've hesitated before because they got burned not only in the dot-com bubble and the financial crisis and the tulip mania of cryptocurrencies and this, that, and the next thing. And here we are, they said, hey, I'm setting out, but now AI is gonna change everything. It doesn't matter if there's jobless claims and no manufacturing here, and we don't need to do any of that because AI will take care of everything and we'll all live like Jetsons. Meanwhile, on that same planet, somewhere else is the Flintstones, you know what I mean? So be careful what you wish for, mama, papa. CNN says that the bear market is over, but the bear economy isn't. The Eurozone has sunk into recession, and some economists fear that the United States is next. We're worrying about rate hikes, inflation, lower spending, layoffs, surging mortgage costs, and a war in Europe. That's a strange place to find a bull market. Is it because it's a bull doo-doo market? You tend to see bull markets coincide with economic expansions, not economic contractions, said Samir Samana, senior global market strategist for Wells Fargo Investment Institution. So why are the bulls running around in a bear economy? It comes down to two letters, AI. Like many bubbles, this will end just the same. It'll pop, and the goodness will come later on, like a dot-com bubble. Anything that ended in dot-com, people bought up, like with cryptocurrencies where there's like 21,000, any company would just pump and dump. Same thing with AI, you put in a call and you say how many times they said it and they were the AI and the stock price shot up. We're still in the beginning phase, ladies and gentlemen. This is a multi-year process, a multi-decade process to finally reap the rewards of AI and blockchain. Just like it took many decades for the internet to finally give us Amazon and Google and all these big companies, right? You don't want to get into it. But in the meantime, if you're a trader, by all means, trade. Guess what? That you're not an investor. You're a trader at that point. And show me one billionaire trader. Yeah, I'll wait. But I can't wait too long because this lifetime is precious to me, okay? You can show me because I'm sure I'll still be waiting in another lifetime if you believe in reincarnation. But I haven't seen a billionaire trader. Have you? Listen, I understand if you want to day trade, by all means have some fun. If you're good at it, congratulations. But I haven't seen any day traders from the dot-com bubble or the pre-financial crisis era. You know, they keep disappearing. Don't get into the market right now because there's a huge mania. Things are at the top. We do see data all pointing to a contraction just around the corner. Take some profits, ladies and gentlemen. If you are in the green, ladder out. Take some profits, sell, hold that cash, hold that dry powder, hold that cheddar. That way we can re-enter the market during tax harvesting seasons, during the next year's general election as well, in the beginning of the first quarter when things I suspect to be very, very low, and the recession will be here. There will be many phases, but until the world capitulates, right now it's too frothy. We see that in the stock market as well right now. We see the trends between the NASDAQ and the Dow Jones, and historically speaking, there is always a pullback, a pull up, and then the final blow down. We don't want you to fall under that, right? There is a micropsychology, and we're gonna cover that right now. Ladies and gentlemen, we're here at TradingView. We're gonna look at the Dow Jones Industrial Average. We're on the weekly chart. The weekly chart basically means that each one of these candles is 1 week, where we can see that 52 of these candlesticks will make a year. We can go all the way back to the great financial crisis of 08-09, and we can see once we come back on top of the moving averages, where it takes the last few candles and it makes these moving averages. We have 50, 100, and 200, respectively white, green, and orange, and we can see that we've been riding the moving averages ever since the great financial crisis to break an all-time high. When we had the COVID-19 pandemic, we've reached an all-time high. It corrected our market because because of history, and we've corrected quite nicely ever since. So it only took 1 year, and we've retested our previous high, and we broke into price discovery. Right now we have this as a current price target for this bounce back, but I doubt we're gonna get there. Right now we have this recovery that we've all been talking about from the previous correction. We can see that the correction from the all-time high that we've experienced all the way down to October, November of last year, we see roughly 22%, right? So about in the 20s we've had a correction, and then we've recovered, to the previous high. We're almost there right now, around 21%. We still have a little bit of room, right, to make that 22 percentile. The reason I want to bring this up is because we can see that this bull market, since the great financial crisis, we've had a high, we've come down quite a bit, right? We had a low set in, we had a higher high from this relative high to this one, so we had a higher high, and then we came down a little bit. Now we have a lower low, right? And then we have this consolidation that's been happening recently, right? That's sort of forming a triangle, this cone wedge shape, right? And so if we were to have a look at what's going on in our history, we see that this pattern isn't new to us. We see that this pattern, this wedge, right, is something that we've seen in our history before, where we have a low, a high, and then a lower low, right? This sort of angle over here. In addition to that, we have broken out of our channel, right? We've broken out into our channel, and we've retested this area, and that's where we are right now. So if we were to come down and break this wedge, I expect us to come down quite drastically, and I'll be sharing with you why I do expect that. But before we get into that, I do suspect that the next month or two will still be in the green, and then we will correct because the summer euphoria would go away, and that would give us our completion to basically essentially match this 20ish percentage. But this percentage, again, we're still in our 20s right now, right? But to break 22, we'd have to come up just a little bit more, which also coincides with these momentum indicators. Here we have the RSI, here we have the MACD. The RSI and the MACD are momentum indicators. They tell you how the momentum is going, like the inertia in a bus. When people ride the train or the bus or the airplane, when it takes off and you feel that jerk, that is inertia, that is momentum, right? And so we see here that this current high and the RSI was reflecting in this price action, and then it acted as resistance around here, and then right now we're very close to touching that, and that would probably give us that completion of 22%, and then I expect us to get rejected. We see this in history as well. If we were to go back to the 30s, I want to show you what that looks like. All right, so we're here in the 30s, right? We see the last decade from 1920 all the way to 1930s was quite bullish, very similar, right? There's some troughs that they had, but they were riding the moving averages, and they had a top very similar to us. If we were to zoom in a little bit, we see that they had something very similar, where they had a top, then they had a massive correction, okay? That correction was closer to 50%, ladies and gentlemen, not like the 22% correction that we've experienced. They've had something a little bit more drastic. But not only that, their recovery was also the same, right? When I was telling you it's about 50%, there we are. These guys came down by 50 and it came up by 50. So imagine being in this time and saying that, hey, this is amazing. We've rallied by 50%. 20% is the technical, where people are saying, hey, we've entered the bull market. I want to make sure you guys are aware that historically speaking, it does not mean that we're in a bull market. I know people say that because of money printing today is a lot easier than back then, right? But keep this in mind. Historically speaking, the 30s, well, this is what happened later, right? It came down quite drastically. Yes, I know it's quite ugly, right? And so what I want to show you is, even though this market corrected quite a bit and then it rallied quite a bit, it does not mean the pain is over. If we were to go from where we are today or where they are today, right, all the way down here, 85% correction was in the bag for them. They broke the moving averages. It got rejected. Came down to a lower low, right? Here's a low, this is a lower low. Here's a high, this is a lower high. They got rejected by the moving averages. They kept getting hammered down
until there was a sort of double bottom, right? So it's not, it's a ladder down, but it's quite quick, right? So it's very much like a escalator or an elevator rather than this long-term bull from the 20s all the way up to, you know, it basically erased from, you know, 1929 to 1932. It took 3 years for 10 years of work to be erased. Actually longer than 10 years, because we haven't reached, yeah, it took longer than 10 years. It erased quite a bit of time, right? So I just want to bring this to your attention because this is, I believe, where we are right now. We're in this complacency stage where we came down, we corrected quite a bit, and we're moving up. And now I expect us to be turning down. We're going to be forming, you know, another double bottom. We're going to be forming this double bottom soon enough, right? We're going to be testing that. We're going to break down below the moving averages, and I fear that we may be coming all the way down as well. So let me go back to where we are today. All right, so just like in the 1930s where it took a decade to come up, I'm worried that we are here near the end phase and we may be entering into a correction where we'll be putting in a lower, well, a double bottom, because we'll be rejected from here and we're going to be having to match this area as well, right? So unfortunately that is what I suspect. I do suspect this to eventually come down later on, right around, say, you know, it'll probably be something like this where people will be taking profit losses, but I don't know what time it is. It's very difficult to estimate time, but I do suspect us to come down. If we were to look at, if we were to pull out the Fibonacci, we would see that from the recent lows of COVID to our peak highs, right, we see that it's been, you see that there's a pocket here of 25, 24, where I believe will be a good entry once we break this low, because there's all this supportive activity over here. There's volume here that a lot of people will be entering here. But worst case scenario, I do suspect that 22,000 will also be a place where some people would also enter as well, right? That would essentially give us a 34% correction. Now, if we were to get this bad, I do suspect that quantitative easing by the Federal Reserve and the Treasury, right, would come into play to sort of correct the market, because a lot of things would be breaking. The only reason I also suspect that it might be this severe, it might be very quick, is because there's a lot of over leverage and a lot of bubbles in our market today, and that cumulatively will bring us down here, right? So I want to bring that to your attention. That is one possibility where I'm looking at as well. In addition to that, the market psychology, where we had this long, you know, bull market, and then we've had this low over here where we corrected, and then we put in a lower low, and now we're in this what I call complacency stage. But as I showed you in the 30s, this isn't something that is new. But in addition to that, here we have the Wall Street cheat sheet, the psychology of the market cycle, where there was this euphoria phase that we've experienced because of the bull market as we're riding the moving averages. We'll calm down to put in a low, and then we had a high, and then we put in a lower low, just like this pattern we see with this pattern as well, where we had euphoria, we've come down, we've rebound, and we've put in a lower low. That is what we see here. The euphoria comes down, we've recovered, and then we put in a lower low. Right now we're in this complacency stage. People are saying we just need to cool off for our next rally. People are saying it's all from AI. It's all speculation. AI is still very novel right now. It's not as strong as people are expect. It's not really as good as we suspect, but anyways, that's for another video. Complacency is the phase I suspect we're in. As we saw in the 30s, it'll put in a double bottom and then it will reject. There'll be many phases to it all the way down where there will be this double bottom that I'll be expecting, where this is where we should enter. So make sure to take some profits right now, because we are in the complacency stage of this market, and then from here we'll be able to re-enter the market once it corrects quite drastically when we're over here, right? All right, so that was the Dow Jones. Now we're looking at the NASDAQ, okay? So in the NASDAQ, same sort of thing. We had a great bull market, and now we see the same sort of pattern as the market psychology we just explained. We have the top in November of 2021/January 2022, and we see that correct roughly 38%. From the bottom to where we are right now, that's also roughly 37%. So we see that it has that sort of same retracement as the Dow Jones as we have today with the 30s, and with the market psychology we see the same, low coming up and then coming to a lower low. Then there's this complacency stage, but that's not it, ladies and gentlemen. We're not only seeing this today in the Dow Jones and in the NASDAQ, and previously in the 30s of the Dow Jones, we also see this in the NASDAQ in the .com bubble. Let's have a look. All right, so we're here at the NASDAQ. We see that same sort of long-term bull market. We put in our top, and then we came down, we corrected, then we put in another one, and then we came lower to a lower low, and now here is the complacency during the year 2000. All right, and what happened right after that, ladies and gentlemen? Before we get there, let's have a look at these retracements again. We've talked about how there's always a pattern where it's roughly in that same stage. Here we see a 40% drawdown, roughly speaking, and then from here to say up there, roughly about 40% again. So we're seeing a lot of similarities that happened in the past to what we have today and the market psychology. And that unfolded. We look at that, that's crazy, right? From the bottom over here, same thing, around 40%. But from here, rather than 85% in the Dow Jones during the 30s, with money printing a little bit easier today, we see 61%. So that's why I do suspect that it won't be as bad as before in the past, because quantitative easing is a real thing today. Back then, it was a little bit it was a lot different. But I do expect there to be exact same things that we covered before as we did today. We reached a peak, we put in this sort of pattern for the market psychology, and we're in this consolidation phase. Here's a low, that's going to be broken down, right? The double bottom, it's going to be rejected under the moving averages, and there's always going to be this sort of stage. We're going to be looking in the future for this sort of double bottom pattern, just as we saw in the market psychology over here. And that's when I suspect it will be a great entry. That's what I wanted to share with you. We do see the complacent stage right now. We want to make sure we take profits while things are okay. I'm personally 20% still in equities of my equity portfolio, not my assets in total, but just my equities. I'm 20% left into the market because I got in early in quite a few projects, but 80% of my equity percentage of my total assets, 80% is held as cash, because I do think that the market will correct quite severely, and I need money to re-enter to buy more equity as the market corrects, and that's my advice for myself and what I would suspect to move forward with in the market.
So we see that complacency is where we are right now, and I do expect, using not only data but technical analysis, that the market will draw down further. Who was it? Was it Warren Buffett who said buy when everyone is capitulating? No, right? And when there's blood on the street. Right now we see extreme greed in the market, ladies and gentlemen, and we do not want you to hold those bags. While we see the executives of AMD and NVIDIA, sell those bags, sell the AI, sell the same company. Oh, but Basil, they're using it to fund the company. Yeah, is that what we see historically? Executives and directors sell massive amounts of their own private shares to fundraise for these companies. And then what happens always with these companies? Oh, but they're gonna buy back later on. Well, when that happens, then you enter, but don't speculate on that. Ladies and gentlemen, do not be greedy right now, because greed is at an all-time high. And if these guys really believe that AI is going to be good, they would hold, but they're not. They're transferring the bag onto the retail investors. They're going to give somebody a call, and then the market's going to drop like it always has been. Do not be fooled by these predators. When the VIX are this low, we see extreme complacency. All I'm saying is looks can be deceiving. And when we see the stock market go up by 20% or more, you're probably saying, man, that looks good, but don't be fooled. The top 7 companies, like I've mentioned again and again, are the ones who are leading this pack. All I'm saying is that there's a lot of distortions right now in the market, and the hype, the mania, the psychosis of society, I don't want you to be falling victim yet again, because history has shown us that you do not want to buy at the top and hold the bag on the way down. Right? We can see the market breadth right now. That's an all-time low. It's even lower than March 2000. And what happened in March 2000? What, did you forget? You know, like, this is gonna happen again, ladies and gentlemen. So just be very careful. Every time we see the 10-year and the 3-month yield inversion, there's always a false rally, and I don't want you to have to pay the price. We see that the rally is always never strong enough to go into, you know, all-time highs, and then price discover. People always capitulate and hold the bag that are retail, and institutions pull the rug under them, and then the market drops 5, 20, 40, even 50% sometimes, close to 50% sometimes, all the way down. The recession technically has not started yet, but it's always a lagging indicator. And by the time the markets figure out we're in a recession, it would have been too late, because you know, all these top stocks would have been sold by then. There would have been a huge correction, and then the people finally get the news, you know, 6 months later, that 2 quarters of GDP and unemployment rate has been negative, and yes, officially we're in a recession. And for those 6 months, the market has been dropping, and people are starting to connect the dots. And I want you to be the last one standing and not one of the victims along the way, like some sort of Squid Games where, you know, you're gonna be moving when they look and boom, you're hit. Right? We want you to make sure that you get the advantage before they officially look your way and tell you what you need to hear. I understand that you might be bullish and you're saying, forget all that data, I have data of my own, and this is a bull market, we're turning it around, we're going to be testing the new all-time highs and be entering into the stratosphere. But let me hear you say it is different this time. With that, ladies and gentlemen, I want to give you a like for making it this far and for investing into yourself. Subscribe if you haven't, and I'll see you guys in the next one here at Financial Almanac. Peace.